What up, everybody? We're the Startup Brothers, and we are back for episode number 4.
Oh, yeah.
So, just so everyone knows, there was some confusion. This is being filmed on June 14th. There's a slight delay between filming and actual production, so we can be consistent. But we're trying to keep up to date with the markets. And for anybody who's a first timer, I'm an angel investor in 30 plus startups, founder, operator, exited as well. So I'm also an art collector. But on the other side, still a founder as well, is my brother in arms, Maxwell.
Maxwell, founder and CEO of Peel Away Labs. I invented peel away bed sheets in college because I noticed my friends never washed their sheets. And now we sell today to caregivers, potty training, special needs. And we're working on many partnerships in the healthcare industry. But wow, it's a wild ride out there. The business plan has to iterate on the fly.
And that's kind of what we're discussing the last 3 episodes, and specifically on this one, is iterating on the fly. For anybody who's been a founder the last 10 years, basically anybody born or in business after 2008, 9, 10 has never seen a recession. So everyone is a genius, yay, when things are just going up and to the right. And now we're seeing what happens when that doesn't happen. And it's easy to tell. Kind of anecdotally, we've lost about 4 trillion in stonks in the market in the last 6 months. And then just basically yesterday, we capitulated down $1 trillion in crypto, where at the peak it was about 2.5 trillion when Bitcoin was at 64, Ethereum was at 4,000, 4,500, and all those altcoins, shit coins were just doing whatever they do. And so now crypto fell below $1 trillion. Give or take. And so what happens when money evaporates? And Max and I were discussing this before. Basically, where'd $5 trillion go?
Yeah.
It's not like it was just sitting there and people cashed out $5 trillion. I'm not smart enough to fully understand how that works in terms of market cap, what's actually liquid. And I see it at least in crypto where it's great, we have this valuation, but you can only take out this much. That's probably the only
or you
thing
can't take
I
it
think
out
is
at all.
positive. Right, there's no liquidity, yes. We'll talk about Celsius, and they stopped withdrawals, and all these bank runs we're seeing in the fall of Luna, which was 60 billion at its peak, and now zero, and they rehashed it, and there's no implications for it. But these are interesting times. Great, 4 trillion wiped off of stocks.
What does that even
Does that mean there was actually 4 trillion in paper? I think on paper there was 4 trillion, but could you actually take out 4 trillion? I have no idea. But just the mental math that was there once, and now companies, as we saw, great, we all knew it was getting weird, that companies were trading at 50, 100x revenue, some in the hundreds, and old school companies doing PE, price to earnings, which tech startups don't have, because that means you have to have earnings.
Yeah.
And so then it was PR, which is price to revenue. So look, we're always trying to capitulate what's going on in the market and make up new
We call it
facts and figures.
Price the hype.
Right, and that's part of what it is. You buy into the hype, and you pick stocks that you think can go up. Why? Because they go up. And so, as the last episode was kind of called, getting back to basics, unit economics, and unfortunately, right, it takes 6 months. It takes 10 years, almost 12 years, to build a bull market, and within 6 months, you flip mentalities because interest rates are going up.
Yep.
Inflation is going up. Not playing blame here. We're just talking about what the implications of it are. And so basically, the Obama era had 0 or so interest rates, which is the money going between banks and what they charge. And it was basically free money. And so great, that's how you pump the economy. The Fed basically has 2 levers they can pull. And now that money isn't really free, it really messes up all of your calculations. Because when you increase 1 or 2%, 50 bips, 100 bips, and that's just fancy terminology, right? 100 bips is 1%. So we always have this jargon that sounds fancy, but mortgage rates are going up. So if the mortgage rate goes up 1 or 2%, that means the value of your house has to go up 10, 20, 30%. So there are magnitudes of scale here that are really interesting. And so from at least a VC perspective, that magnitude now affects the founders, which I want to ask Max about in terms of cost. I'm seeing on the back end my companies have to potentially raise costs. They have to figure out what their budgets are, what their runway is, and then also what their budgets and runways are of their customers and trying to adjust for it. So as you said before, it's like all these spinning plates.
Yeah, it's a really cool, opportunity because it forces you to see how your product could actually perform in an inelastic or elastic way. Um, and what that means is, is my competition going to chip away at me if I increase my prices? Or how far can I push my customers before they start retroacting orders or at least wanting to order because my prices got too high? So this is going to be that period where either you have the best marketing humanly possible, or you have to have a quality product that people need and want. So in these markets, I've been very lucky. I always say, back end of a manufacturing business is your manufacturer. And I don't own my manufacturing facilities, even though I say I'm a manufacturer of the product since it's our patented products, and we have a wonderful relationship. But they have to source materials themselves. They have their own costs. Their electricity goes up and down, and weirdly, governments shut it on and off. And we have to prepare for these moments. And when you have a great relationship with your back end, whether it's developers or yourself, you could be the back end, or manufacturers, you always have to make sure you guys are on the same page and thinking together, or at least somewhat have skin in the game together. And so, my manufacturer proactively has reached out to us saying, I believe we should stock up on material because I think the price is going to go up. And
All right, you kind of broke up a little bit. I can't hear you, but I understand what you're saying in terms of what the price is and how it's potentially increasing from the lowest level of basically your manufacturer has costs. You have to get either cotton, I get the metals, the lithium, the materials. And then how does that translate all the way up? It's kind of like the krill being eaten by the fish, eaten by the bigger fish, being eaten by the whale, right? You can't eat too much tuna because of the krill eating too many pollutants in that sense. And so as the costs go up, I've seen this with my startups that are in at least the physical hardware business that, as Max was just saying, you have to anticipate where the costs are going. You hedge it. So as we saw with Target and Walmart and all these COVID era retailers, basically they have so much inventory right now because they bought ahead of time. They wanted to make sure they were in stock, because if you're not in stock, you're losing potential capital, which is also hurting your revenue. But if you're overstocked, you not only have depreciating assets that are sitting in a warehouse that cost you money, and then you can't buy anymore, it then disrupts the actual inventory and your suppliers.
sorry
And
about
so,
that.
yes, at a high level, from a startup perspective, I'm an investor. I can be like, great, this is something that you should look into. This is going to cause a problem, all of these kind of rising costs. So you hedge it. But that is then an upfront cash cost, because you have to probably buy a little bit more inventory. And then you're hoping that you can sell that above what your already supply and demand issues are. And so on the other side, we're saying, hey,
Yeah.
actually, at least from an investor perspective, you need runway. So maybe you can take a hit in terms of a little bit of price, as long as you figure out what your inventory is, what your sales are. Maybe you'll take a hit on revenue just because you rather, it sucks less than taking a hit on holding inventory and not selling it, and then giving it away. It's depreciated. You can't do anything with it. You have to destroy it. So right now we're telling everybody cash is king.
Yeah.
So it's an issue, but as long as you have runway to weather the storm, whatever this proverbial storm is, however long it lasts, it's a collective mentality. We're all down. The markets are down. People are laying off, and eventually something will flip and be like, okay, things are looking better. We see a light at the end of the tunnel. So I have 4 or 5 companies, my investments, pre-seed, seed plus, seed extension, post-seed, pre-series A, whatever you want to call it these days, that are raising an initial 1 to 5 million.
Yeah.
And it's a slight up round. They're opening up their previous round, so they're taking a dilution hit. But as Max has said in previous podcasts that we've been on, it's a living, breathing company. You can't just let it die. And so, would you rather have 100% or 50% of nothing,
Exactly.
or take a valuation hit and still own your company and survive this? And as everyone says, you'll come out stronger. You'll have better unit economics. This forces kind of survival mentality that you cut to bare bones. Unfortunately, that means layoffs and actually figuring out what your unit economics are and focusing on certain SKUs.
And it's going to weed out a lot of companies and a lot of cryptos that should just never be there in the first place, or just don't have a good core, strong, competent team that could just be persistent and consistent and always iterating. Um, and this is actually, the good times because it weeds everybody out. By the time we get out of this, hopefully, the strong will survive.
And that's the goal. And that's what we've always been preaching for the last 10 to 12 years, that the best companies are built in a downturn because they had to be focused on unit economics, on potentially being profitable. And I'll make it very clear, as a angel and pre-seed seed, I don't care for profitability. My job is to pick companies that will raise more capital. It's nice if you can show a profit, if your economics are there, but my job is to help you find either that product market fit or that there's something there. A lot of this has to do with the companies at kind of Series A that the investors are saying there's something here. If you just raise another 5 to 20 million, depending on your industry background and expertise, at the Series B, you got this. Here's growth capital so that you can continue your playbook, refine it, and at that point, that's where everyone's really expecting this profitability now and being a little bit more lean, right? So Eric Ries came out with the lean startup years ago, and it was great because it was a startup mentality, I think around like 2008, 9, 10, 11, 12, that you should do this. And then, okay, then VC started to raise 100 million, a billion. SoftBank came in with 100 billion, and we just started pumping companies full of capital. What did that do? Well, the difference I see between the dot-com boom and at least now is dot-com, a lot of these companies had almost no revenue. They went public, they had zero revenue, huge costs, and that wasn't as sustainable. Now, I almost equate it to Goldilocks. That was too little, too cold. Now they're too hot. They're doing a lot of revenue. They're growing really fast, but they're mounting a huge loss. And that was cool for a while. Growth at all costs, which is now mostly gone. At the pre-seed, we still want growth at all costs, but that's only in the millions of dollars. It's not at the massive scale that we've seen where Ubers and all these other companies are losing billions of dollars a year. And billions of dollars in the global economic world is still pennies when you're talking about trillions. But that adds up. Money was basically free then. They could take out easy debt that they would pay over years, and some really sophisticated accounting financial CFOs would figure all that out. That's not my problem. My problem, hopefully, getting them there. But now that money isn't free, these highly valued companies, which mostly I equate to the SoftBanks of the world and a lot of these kind of private equity banks and hedge funds coming in saying, great, I'll value you at a high valuation. When stocks were high, their books were high, right? So the Tigers of the world, they were doing almost one deal a day
Yeah.
last year. An ETF, they're basically an index fund of startups. And you know what? Fine. It's a huge mentality of it's a hit business, home runs. If you do 365 investments, if
One of
what,
them's going to hit.
10 to 20 of them, 100x, it makes up for all of it. Look, they play a dangerous game and they had a strategy that was working until it didn't. It's always a game of musical chairs. But at least from the funding perspective, should have some of these companies gone public sooner? Sure. But if you watch stocks, they have to do quarterlies every
Oh,
single
yeah.
quarter. That's why it's called quarterly. So they have 3 to 4 months to show growth, and then that changes their roadmap. In the private world, they can do basically whatever they want. So they can build a product over the course of a year. They can burn a lot of money, and that's fine. But the public markets demands quarterlies. Like Facebook, they spent last year when their stock tanked 20-25% in a day because they burned $10 billion on this metaverse AR VR world, which private companies can do like Magic Leap, and they're heralded as the great startups, but you do it in the public markets, that hurts, especially when they went from 10 to 20 billion in net income every single quarter like clockwork to actually losing money. It was like, uh-oh, something's changing.
When you have a
And
company,
so,
the people that judge you in your company is essentially you're your biggest critic. And so when you go on the public market, you can imagine smart people, you can imagine Karens, you can imagine all the above. But what bothers me the most is it's the analysts that are arbitrarily making up whatever your forecast should be. And, I don't think companies should always be growing. It should grow, make sure the growth is sexy and good, grow, make sure you got good customer service. When you grow too fast, it's not good for the customer. And this is what happens.
and that's what we do in startups. We always tell them grow, 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 plateau, because it's private, they're allowed to, and that's expected. We still want to see growth, but we want you to potentially cut it back. One of my companies last year raised a big Series A, and in one of his updates, he was worried that growth had stalled because they were hiring. And he wanted to make sure they had a good culture, but they went from 15 people to 60 people in 1 year. So I told him, he knows who he is, that's actually good. Let me make that clear. I don't know if any of your investors told you that, but that's expected because, as Max said, you don't want to break the wheel. You grow, you raise your money, it's private. You can then do whatever you want. You have to maintain that growth, create a platform, and then grow from there. And that's what he did, but no one told him that. And so, yes, anecdotally, it's easy for me to say that, but I've seen that with a dozen other startups. And so, my words of wisdom that I got from somebody else is hopefully caring to these founders that that's just one problem. It's like, oh no, investors are going to be worried, my board's going to be worried, but storytelling. I don't want to break my company. I've raised a lot of money. We have 2 to 3 years of runway. So if I don't grow for 3 months to ensure that my future will be better, wow, your investors will be like, oh crap,
Yeah.
you are smart and you are right. We made the right decision giving you money because you're in control. But once you go public and you are kind of at the beholden of corporate, someone's just saying like, I start a company so that I'm in control. Not really. You have your investors. Yes, you can bootstrap and you can have a nice lifestyle business. Max is laughing because he'll discuss this after that. You start a company, you raise capital, great. Then you have a board. That's pre-seed and seed. It's kind of like training wheels, but they still ask you a lot of questions. They annoy you, hopefully in a good way. And then the whole idea of a startup is to fight the man in the corporate system. But I'm an investor. How do I make money? Corporate will buy you, or you go public and then corporate will run your day to day quarterly.
Yeah, everybody says start a business, you get your own hours, you set your own times. Once you build something that has a heartbeat, it's not even up to you anymore. There's so many moving pieces, and in these downturns, you know, the highs and the lows really get to the founders, right? You just raised millions of dollars. Imagine the adrenaline rush you have and feel
And that's
invincible.
just the beginning.
But you saw how fast COVID went by, or at least the 2 years of lockdown. That went by in a jiffy. Each month cost me a lot of money. And if it was my real life, I'd be living lavishly if it cost me that much money every month. But it's a living, breathing thing, and then it has living, breathing things, and then it has technologies that break as well. So you're really reliant on the thing that you build. I don't like when people say it's your baby when it comes to the emotion of the business, even though, as founders trying to detach ourselves, but there's always some, conjoining twins going on. But it's not fun hiring 1,000 people and then firing 600 people. The emotional toll that it takes on founders. I cry more than the people that I unfortunately let go. And so imagine doing all of that while trying to acquire customers, grow, stay successful, and really, you have to manage your budgets. It's this weird feeling. You have to manage your life, and then you have to manage the life of what you created that's bigger than yourself.
And so we see this with a lot of our founders right now. Either their marketing isn't working, their product isn't what their customers need, or they're close, but they just need more capital. And so last week I hugged one of my founders, right? A lot of people ask me what my job is, and I say, great, I'm an investor. Really, I'm in the business of exits, but also I pay to help you, which is somewhat ironic, but in the long term, hopefully it pays off. But the last third of my job, which is really kicking in right now, and people always laughed and I kind of giggled, was a third of my job is marriage counseling. If you're co-founders or the marriage to your company, the marriage to your employees who you're in charge of. And it's refreshing when you can have a conversation with a founder because look, I'm a small investor. I don't run your day to day. If you listen to me, great. I appreciate it, but at least I'll be real with you. And I'm not going to bullshit you that, oh, good for you. This is great. I reply back to the updates, and that's all they want. I even tweeted out, and people push back that there's a direct correlation to company updates that are hopefully monthly or quarterly at the very least to their success. Why? Because they track everything meticulously. And that's what we hope for. And yes, we all want to be value add. Most of your investors won't. I can't help all my companies as well, and I haven't been able to. And I don't take credit for a lot of their success, a few things that I can, because maybe in January I can help you. This month in May, June, I help you raise $1 million. You launch a product in August, September. So like 3 or 4 times a year, I might be able to help you. But as long as you're benchmarking and you're seeing day to day, as we've always discussed, like the plate spinning or turning the knobs to see what works, not everything is perfect. We always want a fairy tale story. And I tell founders, look, your cap table is a little complicated. You raised a bunch of different notes and stacks, and you have all these different emotions and different people that are giving you advice. Look, it's not clean enough for me. It's not a fairy tale. I know it won't be, but at least let me be some part of something clean. So when it gets dirty, I can get my
Yeah.
hands in on it, but not right away.
7 year was a Twitter was a 7 year overnight success. Yeah, that's what it feels like.
Yeah, and then
You know the odds you're going against, and you know the companies that you're fighting against as well. And then you know the environment you live in is also not purposely against you, but you just have to coast with what's going on. None of it's the full enjoyment of the quote I want to start a business to make my own times. And there are businesses that could be passive, which could be a good business for you. But Trace and I, he looks at businesses that are going to scale, that are going to be larger than life and bigger than a company that's next to it. And that's what they're looking for. And it puts pressure on founders, but that's the good pressure because I've learned the new generation of angel investors come with a lot of value add. Why? Because they care a little bit more in the sense that they're more relevant and that their connections and Rolodex could be open to you, opposed to, I know the old CEO of that major hospital, see if he can get you in. And that's a wonderful, awesome connection. But
wow.
I rather you introduce me to the best SEO person in the country or the best digital agency that you've ever worked with a relationship, a warm relationship. Those are the value add, or take this direction instead of that because the margins in my experience might be a little smaller, but it's less work. And then maybe even help guide. So the new generation of angels seems like they come with a massive relevant value add. And it's something that you've come to appreciate during these hard times.
And so the last thing I'll say on that before we jump into some emails is basically it's a red flag when I meet a founder. They're probably a first time founder and they're like, minimum check is 25,000. And to Max's point, yes, we write those checks 25 to 50,000, which in the landscape is still a tiny check. But these operators, they have experience working at a company. They're great at product management. They're great at biz dev. They're great at sales. Not everybody can write a large check. And $1,000 check, a 5,000, even 10,000. A lot of my friends are doing this. It means so much more to them because it's their personal capital opposed to someone else's. And the difference in game of they work for their check. Same. I write a small check and I want to work really hard for you because at some point I'll join a VC, I'll raise my own fund, or I'll start a company and I have to go raise capital. I need these people to say I was there for them, that Trace's check of 25, 50,000 was more valuable than that VC who gave me 1 to 2 million. So I get emails, I reply to the updates. I've made introductions that have garnered millions of dollars in follow-on
Yeah.
capital or in sales. And then I get updates and people thank certain people. I'm like, great, I know they're an angel, they're an operator, and they made you an introduction that was life-changing, personally and professionally. Why? Because it means so much more to them sometimes. And they're just so grateful
Yeah.
that they were able to invest in your company and you allowed them the opportunity to be a part of this.
And when I feel like you're an angel investor, it's you. right? You're not doing it for anybody
Yeah,
else besides yourself in many cases. And so, you don't have to report to anyone. And so it makes it feel good. You want to help out. But I know you're on a timeline of 4 to 7 years until you exit these type of companies. And so if you're still around
hopefully.
within 4 years, that's awesome. Good work.
Yep. And so email that I had, I actually opened it up just specifically for this, is terms are coming back, and the proverbial pendulum is swinging from ridiculously founder friendly to what I call more normal, like taking a board seat, 1x liquidation preferences. Someone this morning pitched me a company that they didn't want a safe, the investor, because then they couldn't get a markup. They couldn't mark it up book to book depending on a note or a safe, because a note is technically debt and you can value debt somewhat. We'll see caps, and safes are for future. So depending on semantics, you can't mark it up. But then they also, in the note, we're getting 5% interest or 10, 20% interest, which is almost like a ticking time bomb. Not that it would be too much dilution, that says, by this time, you should then do a priced round. Whereas if you were a hot company, you were just getting term sheets thrown at you. I've seen a lot of uncapped as well, just the ability to get in. And so this isn't a bad thing, as I'm saying, it's a reversion to the mean. This is what 10 years ago when I started in the tech scene was normal. You did a price preferred equity round. Yes, it was more documentation, a little bit more expensive, but you set a foundation, things weren't as crazy. Everything was safes these days. You could raise millions of dollars on a safe, no accountability. There was so much money that's like, oh, it didn't work out, great, next one. Or if it's working, just try and get in and do a 10 million, a 20, a 50 million safe, because you can. And you know what? If you can raise the capital and people are investing, great. Just know the expectations that come with it. And so I think we're going to start seeing this. Hopefully nothing egregious. At the later stage, we'll see. Once you start getting those ratchets, those pre-IPOs, there was debt pre-IPO that says like you kind of have to convert or IPO in the next 1 to 2 years. Otherwise, we get more equity. So like forcing companies to actually do something and putting them on a timeline. It's like if you don't set a date to get something done, it'll never get done.
And getting things done is the business we're in. And getting things done doesn't mean it always gets done in the right, perfect way. We were talking about how we just let, hire and fire quick. You might get something done, but it's not done in a proper way or perspective. And so, back to the emails. I have a shipping container that's finally on the water after being delayed about 31 days because the port of Shanghai closed down. So my port of Ningbo was backed up, but it's out on the water. But this is the second container that I ordered on purpose because of these weird trying times. And so what Trace mentioned was the cash flow. And so having a wonderful relationship with your manufacturers, they kind of help you out here and there and bear the burden. And that was the next email I received, which I was referring to, that my manufacturer is reaching out proactively about housing more material for us because he knows the price is going to go up.
Right. They're doing their books, and then they know that it might affect their customers, and that's great. Being proactive about it and actually telling you, like, hey, I don't want to cook my own books and make you buy more inventory, but I have some, I like you, and so I kind of want you to buy it now because it's only going to get more expensive and probably in higher demand later.
And it's not a gimmick, and they're not doing it to be pushy. This is all from the heart, I could tell.
Yeah.
Yeah.
And so, to your second point about layoffs, a lot of companies, I'm seeing it now, like layoff.fyi, if you ever go to that website, but it's making the news. And this is what we were talking about in terms of cash is king. And so we see companies laying off 5 to 10% of people. So nothing significant. It is definitely sad that people are losing their jobs, and it's going to be a tough slog for the rest of the year. But as we've seen, and I'm seeing on the back end, some of our companies considering it, whether layoffs or just cutting back on certain initiatives to extend their runway. It's one of those things. Do you do 5 to 10% and do it over time? Do you cut deep and just say, great, look, we know that like Coinbase just laid off what 18 to 20% of their customers. They went from $1 billion in net profit revenue EBITDA in Q4 to last year, this year Q1, it's like a $400 million loss. And so look, a lot of this is stock-based compensation. It's different in terms of people trading. That's what they do. But we're seeing it with high-flying startups as well. The IPO market, the window has closed. IPOs are also a fundraising event. You
Yep.
generally go out and raise hundreds of millions, billions, and their public comps are hurt. So they have to shore up their capital. And as I'm sure Max knows and a lot of our investments know, people are expensive. You don't just have a salary, you have healthcare, you have benefits, there's taxes on it. And so there's some redundancies and people get comfortable in their jobs. A lot of people got comfortable in investing last year, just saying, look, I got markups, kind of knowing that they were real, not real. So it's something that I expect more of as it starts really to capitulate and mentally people accept it.
And, what have I done? Unfortunately, during COVID, we've had to downsize in everything. We're closing down the office because there's just no necessary need for it on top of having warehouses all over the United States. And being remote for so long, we realized we're pretty damn good at it. But this is where standard operating procedures are the most important. Creating a mind map, creating a whole outline of your business, because if somebody needs to step on board while you're not there, or there's just a department that needs taking over, they know what directions at least they need to go in. This is my warehouse, this is username and login, this is what we usually do. We put up a video of us doing, at least executing on doing it. So this is where you have to get really smart. This is where you're going to spend the extra time getting even more organized. And this is where you start becoming the freak that you were built to be in this startup world. And so between the emotion of growing, the emotion of the outside world, and the emotion of business, it's the fun part of all of it. But do not start a business because you think you're just going to enjoy all the above. It takes 7 years of hard work just to get to your first major milestone.
Yeah, and so on that inspiring diatribe and speech,
Yes.
we're going to end it now. So go out, hug a founder, tell someone you appreciate them, and as everyone called it, like brutally honest, just say what it is. You should always be honest with people. And from that perspective, look, we'll be back. Ask us questions. We're available, and
Constructive
we'll be back
criticism.
soon.
Add the constructive part. It's a wonderful option. Thanks, everyone.
And founders will appreciate it. Thank you.